There's been a big change in the bond market in the last month. Let's see what's causing it and what's going on. We'll use our asset class research tool, AssetCamp, to analyze the bond market. Overall, global bonds, as measured by the global aggregate, were down 2% in the month of December. And let's look at the worst performing bonds. Year to date, we have the U.S. 20-year Treasury bond down 8% in 2024, down 6% in the month. Let's take a look at the yield on 20-plus year Treasury bonds. The average yield has been 4.6% over time. But here's what happened at the end of the year. We've seen yields go up to 4.9%, overall up about 80 basis points in 2024. It's not because inflation expectations are increasing. Here we have what is essentially 10-year expected inflation. And if we go out to the latter part of the year, we've not seen a big increase in inflation expectations. What has changed is investors are demanding additional yield for uncertainty. That yield is called the term premium, and we can see that in this chart. Here's the measure of that additional yield or term premium for 10-year bonds. Generally, over the past 10 years, it's been under 0.5%, and it went negative in 2020 and 2021. And now we're at the highest it's been in 10 years, at about 0.7%. There's a lot of uncertainty in the bond market right now. With the Trump administration coming on, what will their policies be? Will the budget deficit to GDP fall? And that uncertainty has led to higher interest rates, falling price of bonds to where we now get additional yield on bonds, but 2024 was not a great year for the bond market, unless you were on the shorter end of the curve in cash. In cash and short-term treasuries, you're still yielding over 4%, and with the Federal Reserve taking longer to lower interest rates, we'll continue to pick up those attractive yields, at least on the short end.